All right. Hey, Do. Great to have you here kicking off our Terra podcast series. As you know, we're huge fans of what you're building with Terra. We think it's one of the most important and also underrated protocols in crypto. And over the next week, we're going to be talking to builders from all the major protocols on Terra to give people an intro into what Terra is, why it matters, and also give them a glimpse as to all the innovation that's happening on there. So before we start, and just for full disclosure, Delphi Ventures holds a position in Luna, and Delphi Labs is actively incubating a bunch of different projects on Terra. So many of our listeners will have watched my Real Vision interview with you. So I'll try not to repeat too much content, but there's probably going to be some overlap in terms of the Luna's design and stuff like that. But we're also going to cover some new ground, especially towards the end. So for today's interview, I'd like to try and explain first of all why decentralized stablecoins matter, why UST is the only decentralized stablecoin, but also how you think about building on Terra, regulatory challenges, and some of the long term sort of vision for it. So to start with, could you first of all, thanks very much for being here.
Yeah, happy to
And
be here.
then, yeah, it's awesome to have you here. And then to start with, could you give us a quick background on yourself, how you got into crypto, but also why you chose to start Terra? You had a great thread on it recently. I'd love to hit on that.
Sure. So I'm an engineer by trade. So I studied computer science at Stanford, and and then after graduation, I was an engineer at Microsoft for a while. I had the great fortune of being placed in a really boring team. So they weren't giving me too much work. So in my spare time, I worked on a lot of side projects. And then, one of them that was sufficiently compelling enough to get me to leave the company and to start my own project was something to do with Wi-Fi mesh networking technology. So I developed software whereby user devices like phones and laptops could connect to each other via Wi-Fi direct and Bluetooth, such that even if you don't have direct internet access, you could sort of piggyback off of a multi-hop network of the peers around you to get internet access. So we sort of packaged that as a B2B networking solution to large enterprises like amusement parks and shopping malls and others. So while doing that, you can imagine that a lot of standard search queries for mesh networks or distributed networks returns hits like Bitcoin and Ethereum. And then that's how I got sucked into crypto. So I spent a lot of time, better part of, 2016 and 2017, looking into white papers, going to meetups, and, just spent a lot, found myself spending more and more time in the crypto industry. So what was really interesting at that time was that it was always confusing to me for an industry that calls itself the cryptocurrency industry, that there were very few people working on the problem of making currencies better. Most people were either working on sort of very niche apps, so things like betting markets or different types of decentralized exchanges uh, or things like that, or they were focused on building better blockchains. So in terms of making Ethereum faster. But I felt like the most important problem to work on is to think about a situation where a cryptocurrency could be more useful than fiat currency or Bitcoin. I sort of thought about that as the holy grail of cryptocurrency. And that was sort of the founding motivation for Terra. And it is still the mission that we operate by today.
Yeah, your intuition was definitely right. Stablecoins have since sort of, I think, arguably become crypto's killer app. Why are stablecoins so important? Why did you choose, I guess, a stablecoin as the design for this hyper useful currency? And yeah, why have they gained so much traction in your opinion?
Yeah, so I think the most important feature of stablecoins is that it sort of allows users and most users in the world to nominate, either their net worth or their financial holdings in context of the fiat currency where they happen to be domiciled in. So for lots of people in the U.S. and the Western world, it is the U.S. dollar. In China, it's the yuan. In Korea, it's the Korean won, and so on and so forth. So in order to build, let's say, DeFi apps on top of blockchains, it's natural that sort of the base currency that constitutes the liquidity for all of these different applications be denominated in that same currency. So if you look at how crypto operates today, most of the crypto applications, either quote prices or execute trades with the stablecoin as the base pair, and that's why most people believe the stablecoin so far has been the killer app for crypto.
And do you think that'll always be the case? Like in a, let's say, like a hyper Bitcoinization world from the maxis, or in a world where sort of U.S. monetary policy, U.S. loses control of its monetary policy. Do you think it will always be denominated in dollar, or are you interested in some of these experiments like Rye and these sort of non-stable coins, or like different ways to denominate?
Yeah, I think a more plausible case is that fiat currencies tend to peg its could I can see a version of the world where the monetary policy paradigm changes such that the fiat currencies themselves peg to things other than the CPI. So, for example, like the U.S. dollar could at some later point in time choose to peg itself to some combination of a basket that includes Bitcoin, for instance. But I think fiat currencies will always remain in some form or fashion. So, for example, when the US dollar was tethered to gold, it was still the US dollar, right? And just because the pegging mechanism changed does not mean that the US government collects taxes in gold or other types of currency. So, insofar as most users in the world are paid wages in something that's fiat denominated and have to pay taxes in something that's fiat denominated, I think stablecoins will always have a place, irrespective of how much adoption other cryptocurrencies gain.
Makes sense. Yeah, I agree with that. I think for the foreseeable future, fiat pegged stablecoins are going to be the dominant sort of way people denominate and the medium of exchange. Could you give us a quick breakdown as to how current stablecoins work, what the different kind of architectures are, and the risks of each one?
Sure. There's a lot of newer experiments that are happening in stablecoins these days, but as a very broad categorization, there's three categories of stablecoins. So number one is fiat-backed stablecoins. So these are basically tokenized dollars. So the premise is that some issuer, let's say a Tether Incorporated or Circle, keeps a dollar in the bank account for every stablecoin that they issue. So the basic premise is that a user should have redemption rights to a dollar to which he can redeem that to his bank account for every stablecoin that he happens to be holding. The second design is something that follows the paradigm of MakerDAO. So the idea is that in order for every single DAI stablecoin that is minted in the market, there is over collateralization in some sort of volatile crypto asset that's backing it. So the idea is that at any given time, you can redeem one stablecoin for something that's a little bit more than a dollar. So that's what sort of allows the stablecoin to keep its peg. And the last category of stablecoins are algorithmic stablecoins. And this is the category that Terra operates in. And the idea is that we use a set of on-chain incentives to allow the stablecoin to maintain its price peg against the dollar. So in terms of the trade-offs between the different designs, for fiat-backed stablecoins, the first category, the problem is that there's always risk in sort of the integrity and the security of the issuer or the regulators that seek to bring that issuer under their purview. So for example, to no one's surprise, people are starting to figure out that coins like USDC and USDT do not actually have a dollar in the bank account for every stablecoin that's issued. So there's large sort of integrity risk on the part of the issuers as to whether they're actually keeping dollars in the bank account. And what happens if the underlying bank accounts get seized or the bank fails? Then in that case, the entire stablecoin ecosystem collapses. Another problem is that depending on where the issuer or the bank accounts might happen to be domiciled, the integrity of those bank accounts are held hostage by the regulators that are overseeing those accounts. So, for example, if you have a bank account in Taiwan as the issuer, then in that case, then in some cases, all the different types of DeFi apps and other things that use these stablecoins are held hostage to the whims of the Taiwanese government. The risks of the second model is a little bit more nuanced, but the problem here is that the model works pretty well in terms of making sure that there's enough collateral to back each stablecoin issued. But the issue here is that the expansionary pressure for stablecoins do not actually keep in line with how much demand there is for stablecoins. So for MakerDAO, when it had a single collateral model, it had the problem that people only wanted to mint DAI when they wanted to take out a leveraged long position on Ethereum, not when there was an additional demand pressure to purchase DAI from the open market. This led to a supply and demand mismatch, which meant that there was always sort of an over demand for DAI tokens from the market, which led to DAI consistently trading at a slight premium to the dollar for most of its history. The risks of the third model is that it relies on a set of on-chain incentives. So in terms of how these incentives work, given that there's no explicit collateral backing every stablecoin that's issued, there's a risk that these on-chain incentives could fail and the stablecoin could be depegged in the open market.
Absolutely, and I guess I'd add for the second model, for the kind of MakerDAO model, because of the issues that you point out, they've also had to onboard kind of different types of collateral, which themselves are censorable, right? So most of DAI is actually backed by USDC, which has the problems of the first model that you mentioned in terms of counterparty risk and regulatory risk, where Circle can basically freeze the USDC holdings in MakerDAO's vaults and kind of make MakerDAO insolvent, right? So you have like a decentralized stablecoin that's built on top of a centralized stablecoin just ends up kind of inheriting the problems of the centralized stablecoin. Um, okay, and then that was really good, really great overview. And in terms of the like, I guess the trade off between sort of the second design and the third design, which are the only two decentralized ones. You mentioned that the MakerDAO sort of debt based design, it's hard to expand, right? Because you need demand for debt to kind of keep going up, which is uncorrelated to demand for a stable coin, and so you end up with this mismatch. And then with the algorithmic design, it relies on on-chain incentives, so there's always this fear of kind of like the death loop, right? Can you explain maybe the death loop a little bit and how different algorithmic stablecoins try and overcome this, and maybe like how Luna has managed to really be the only one that's kind of really been able to avoid this fate?
Yeah. So most algorithmic stablecoins follow the same design or a very similar design. So generally, there's a dual token model whereby there is a stablecoin and there's a second token which gives you redemption rights to that stablecoin. So for example, how Terra works is that at any given time, a user can trade in $1 worth, 1 Terra USD for $1 worth of Luna. And vice versa, you can trade in $1 worth of Luna for 1 Terra USD. So, during a time when you want to, redeem 1 Terra USD for 1 Luna in the open market, you just need to burn 1 Terra, and then it gives you $1 worth of Luna, which you can sell to, acquire the actual US dollar or Bitcoin or anything that you want. So the problem here could potentially manifest when there are too many people trying to redeem stablecoins at the same time, i.e. a sharp contraction in the stablecoin economy. There could be a lot of people that are rushing to the exits. So what happens here is that if a lot of people are swapping Terra USD to Luna, the value of Luna could be slipping as people are looking to trade out of it. This increases beta risk for people that are swapping out of Terra stablecoins. So this could lead to a situation that is commonly referred to as a death spiral, in the sense that as the stablecoin is being redeemed, the price peg of the stablecoin starts to slip because the cost of doing this redemption transaction increases, which leads to more people wanting to swap out of the stablecoin and so on and so forth until the economy collapses. This has in fact happened to many earlier algorithmic stablecoin efforts. So the reason why Terra has been resilient to a lot of these contractions, and in fact in May, we had a 25% contraction in the overall Terra stablecoin economy, with when UST's market cap was around $2 billion in sort of the grand crash, crypto crash in May, we saw about $400 million of Terra stablecoin sales and redemptions hitting the market, which was absolutely massive. So we handled our prices pretty well. So as swaps were happening, we saw the price peg of Terra USD slip, 6 and 7% for a period of a few days, but then it recovered as redemptions started to sort of smooth out in the open market. So I think the reason that I would have to give as to why Terra is more resilient than other types of algorithmic stablecoins is because there's a vibrant economy that is being built on the Terra blockchain. And I think that's the best defense that algorithmic stablecoins can have against death spirals.
Yeah, absolutely. Because I guess most of the algorithmic stablecoins that came before, and I proudly sort of lost money on a lot of them. they had like they tried to fix this with incentives, right? So having some kind of mechanism design where below $1 there's some incentive for people to come in and buy bonds, which will be redeemed later, but it ultimately relies on sort of faith by speculators and investors, right? Because the algo stable itself doesn't have utility, whereas I guess the approach you've taken is you do have some smart mechanisms like increasing the tax rate on transactions when UST is below $1 and stuff like that. But you also have, I think, the key, which is creating real demand for the stablecoin, which is also what we saw during the May crash, right, where there was a big contraction in because there was a broader crypto crash, and that's kind of how these death loops generally are initiated. But you did see, for instance, UST and Anchor go up, right, which is huge because it means that a lot of people are fleeing to safety, which they see as UST and they see as UST on Anchor, and no one's fleeing to like ESD, right, during a crash or to any of the other algo stables. I thought that was pretty huge, and that kind of goes into the way you designed the way you think about what you're doing with Terra, right? Could you maybe talk a bit about like you've talked about your mission at TFL as helping make UST the most decentralized and useful form of money there is. I guess can you talk a bit about how you're doing this with Chai, with TFI and Mirror and all of that, and how you think about your role?
Yeah. So to speak a little bit more about why algo stablecoins fail is that the launch sequence for most algo stablecoins look exactly the same. So and I think this is sort of consistent across most DeFi launches, but this is especially problematic for algorithmic stablecoins. So generally, the scheme boils down to, look, if you buy and hold some of our algo stablecoins in, let's say, a pool 0, we're going to give you more algo stablecoins. So these are sort of recursive holding benefits that help bootstrap the TVL of these stablecoin projects to, let's say, hundreds of millions or billions of dollars very quickly. But the problem here is that there's no reason to hold these algorithmic stablecoins, when there's sort of like a loss in faith in the yield, or some bright new shiny thing comes along that offers better yield. Then in that case, all the capital flees the stablecoin farms at once, and then this leads the entire stablecoin peg to come crashing down because there's no consistent source of demand that that is formed at the base of these stablecoins. So at Terra, we operate things a little bit differently, right? So the way that we look at it is that there should be no recursive holding incentives, and the only reason why users want to hold Terra is because it's a more useful form of money compared to fiat currency. So and that's actually pretty simple to do, because money is a product with very simple features, right? You can either spend it, you can use it to invest in things, and you can hold it. So basically, you need to offer a better savings experience whereby users can earn a higher yield by holding Terra stablecoins versus keeping money in a Wells Fargo savings account. Second, you need to be able to use these stablecoins to invest in any type of asset class in the world, be it sort of equities or ETFs or different types of derivatives. And third, these stablecoins need to be easy to spend. So if you make money in the first two categories, you need to figure out a way where you can sort of help to pivot users' money at rest into money in motion. So this involves, different types of payment apps and different types of integrations like that. So at TFL, we focus on making sure that these sort of three features of Terra stablecoins as money is better than opportunity costs or other types of opportunities that people can get in fiat currencies or other types of stablecoins. So this is why for savings, we built Anchor. So Anchor is a protocol whereby people can deposit Terra stablecoins to earn a high stable yield powered by block rewards that are coming in from multiple different proof of stake blockchains. So right now, Anchor offers 19.5% yield on stablecoins, which is obviously much, much higher than what you can get at the savings bank or other sort of lending protocols that you find in DeFi. For investing, that's why we started to work on efforts such as Mirror Protocol. So this is a synthetics protocol whereby users can use Terra stablecoins to invest into any asset class that they want. So you can buy price exposure through mirrored synthetics for let's say equities, different types of cryptocurrencies, and ETFs. And lastly, we built out a number of different payment apps such that Terra stablecoins are easier to spend. And these are reflected in Chai and Import in Korea, MimiPay in Mongolia, and some other countries.
Awesome. Yeah. So I guess there's kind of two or you mentioned the three goals there. So the savings, investment, and spending. Could you give us maybe, let's split them up. I guess the first two more concern Terra's DeFi ecosystem, and and then the third is sort of separate and requires, you know, like on ramps in each country and stuff like that. So maybe we can go through those in turn. So in terms of the layer one DeFi ecosystem, like what's the traction like? How are you thinking about it? Or yeah, maybe just give people an overview of what's going on there, because I think most people don't realize that Terra is actually the third biggest sort of layer one ecosystem by TVL. And so yeah, it'd be interesting to give people that background.
Yeah, so it kind of goes up every day. So it's hard to quote exact numbers, but
Yeah,
Anchor, for instance, launched in February of this year. So today, Anchor has $4 billion of TVL locked in the platform in either borrowing or deposits. And we're, month over month, Anchor is growing at, maybe 60, 70% month over month. So,
wow,
pretty quickly. It's Mirror Protocol, for instance, for synthetics has about $2 billion in TVL locked up across various different types of synthetics, such as mirrored Apple, mirrored Doge, mirrored Robinhood, and so on and so forth. So there's a vibrant synthetic, shall we say, equities or trading experience that's happening there. There's also a number of very interesting earlier projects. So Loda, for instance, allows people to lock up funds and then uh, invest in lossless lotteries through the yield that is being generated in the Terra DeFi ecosystem. There's Apollo DAO, which was one of the winners of the previous Delphi hackathon. So they build a yield aggregator on top of Terra stablecoins. So in a relatively short period of time, the Terra DeFi ecosystem really only started in 2021 with the launch of Mirror. So in the first 3 quarters of this year, we were able to start from zero to collectively, let's say, $7, $8 billion in TVL, and a vibrant ecosystem that encompasses synthetics, savings, decentralized exchanges, betting, and all sorts of different things, with a ton of developers joining the platform every day.
absolutely. And there's also some interesting stuff happening in the NFT space and stuff, and I think there's some interesting innovation sort of outside of finance that's starting to seep into Terra. How do you see that, and how does it fit into sort of the three goals that you mentioned before?
Yeah, so um, I think NFTs represent a really interesting opportunity. I don't think those opportunities are being tapped into today with colored rocks on Ethereum. But I think the real opportunity here is allowing digital property rights to transition from communism to capitalism. So what I mean by this is that human incentives in the real world operate via private property rights. So it always relies on a conception of scarcity. But our digital experience doesn't really abide by the conception of scarcity because digital goods are almost always fundamentally not scarce. So this means that in all the metaverses that we participate in, be it, let's say, LinkedIn or Twitter, there's sort of like a grand equality that applies to all sorts of property rights, which means that anyone can create the same property. So if you're on Twitter, like a billionaire has the same digital property as, let's say, somebody that has $20 in the bank account, which is great. But this also means that it makes it difficult for people to try to cultivate property or a sort of economic identity on top of these metaverses. NFTs change this. So, for example, if we had a set of NFTs whose property rights are well respected across multiple different metaverses that we operate in, then in that case, that creates a conception of scarcity in a digital context. It allows people to take the one bastion that only existed in the real world and move it into the metaverse. And you can imagine a situation where you have avatars and NFT properties that you migrate from, let's say, an MMORPG game, and then you bring it to your social, your SNS service, and then you might be able to take it into, let's say, your email and so on and so forth. And I think that's going to be, sort of the connective economic tissue that constitutes all metaverses that we operate in together.
Yeah, very interesting. I have very similar thoughts on that. I guess, how do you think about that existing on Terra, and like, because there's, I guess, limited block space on Terra. Yeah, how do you think about what should exist there, and like what are you focusing on, and how does it fit into the goals that you mentioned before, having this sort of metaverse available? Because it's like most of the stuff that you've built on Terra so far, the DeFi stuff, there's a clear use case for why it makes UST as money more useful, right? Whereas NFTs and kind of metaverse, you start to seep into more of like a pure layer one, where you're just becoming like a sort of decentralized database for these metaverses to run on. And so, like, how do you think about those two goals?
So let me put it this way. So how everybody in the NFT space operates today is that they're really focused on supplying more NFTs, right? Which means that everybody's really busy creating new NFTs that have the same limited features because there's a lot of money to be made in that market for now. But I think a bigger opportunity that is being neglected is giving people an opportunity to use these NFTs. And I think that's super interesting. So, for example, if you had some sort of experience whereby you can, either, so it's kind of like let's say there's like a shopping mall metaverse where you can showcase your CryptoPunks or, Pudgy Penguins or whatever NFTs that you purchased and then showcase them. You can import them into this metaverse and then interact with them in a way simply more than posting as your Twitter profile pic. Then that could get a lot of value locked up in this metaverse, right? And what you could do with that attention, where people are spending lots of time, is that you can add a commerce layer to it. So, for example, if there's a metaverse whereby people are bringing in tons of CryptoPunks and Pudgy Penguins and ether rocks and things like that, then in that case, an interesting experiment here could be in this metaverse, can we add, let's say, a movie theater, let's say in partnership with Netflix, and then have people pay for that service with UST? Or, for example, if there was sort of like a bartering marketplace within this metaverse, can we get UST to be, the quote currency for all those markets? And those
Okay,
are the types of opportunities that we're interested in.
that makes sense. So it's kind of facilitating that third goal, but rather than like real world spending, it's kind of like this digital spending. So you build a metaverse in order to make UST sort of the base currency and decentralized currency of this metaverse. Yeah, that makes sense. Um, and I guess it's relevant to this. Like, how do you think about scalability? Because for crypto to do all the things that it's meant to do, and also for Terra to facilitate, or like for instance the metaverse use case that you're talking about, there's clearly a need for like greater scalability. Do you have like a plan for that? Is it something that you think about actively, or yeah?
Sure. So Terra is built upon Tendermint and the Cosmos SDK, and the Cosmos vision is pretty simple. Every application should have its own blockchain, and then all these app-specific blockchains should be connected to each other via a bridge or a messaging protocol called IBC. So the entire premise of the Cosmos infrastructure is a world whereby different blockchains can interoperate with each other. I actually think that the branding of IBC could be better because it's actually a great scaling solution, right? So like one way that you can think about this is that not all different types of smart contracts and applications need to interface with each other. Logically, a lot of these things are separate, right? So for example, a lot of different DeFi apps might have to interact with, TerraSwap or Uniswap because they depend on that sort of base infrastructure for liquidity. But it makes perfect sense that something that has to do with payroll has nothing to do with sort of that DeFi cluster of applications, which means that we could logically separate them into shards for most intents and purposes. So what you could do is, let's say you can have sort of a logically separated shard that computes a lot of DeFi settings, and then you could have a logically separated shard that has something to do with NFTs and user types of activity, a separate shard for content, and then you can sort of have the main Terra blockchain be the sort of the connective tissue that binds all those different blockchains together, and then all these different blockchains can connect to each other via IBC.
Very nice. Sounds like what Cosmos was meant to be. Do you see like Terra? I guess so what you see is building your own ecosystem of sort of dApps and of different experiences, and then having Terra's validator set like validate across them in sort of a parallelized way, or
Yeah, I would say this is, pretty consistent with the Cosmos vision. Um,
Hmm.
I, it's, and I don't think it's necessarily competitive with what Cosmos was initially trying to do, but I think the idea is that, it's just a change of perspective, right? So
Hmm.
interoperability and scalability are not that different things because you logically separate state machines anyway. But I think it makes more sense to call it a scaling solution.
That's super interesting. Okay, one thing I wanted to dig into as well is you've been pushing like pretty hard and successfully to get UST on other chains, right? You guys backed Wormhole. You've been doing like incentives on Mercurial, which is a portfolio company, by the way, which and I think it now has more liquidity on Solana than it does on Ethereum, or at least it did a few weeks ago. How do you see that go? I guess getting UST on other chains, and do you think there's a scenario where like Terra can succeed even if it fails as a layer one ecosystem, just because it's so prevalent on kind of other chains?
Yeah, so I mean, this is sort of like a confession, but Terra became successful as a layer one almost purely by accident. So, like, our main goal was to make sure that we could create use cases around Terra USD. And in the beginning, when the Terra blockchain first launched, it didn't have a smart contract layer. But in order to build use cases around UST, we needed smart contracts. So we added like a Cosmos module on top of it. And then we built out the initial applications, Mirror and Anchor, on top of Terra. And that sort of gave the inspiration for tons of developers to either build apps that are adjacent to Mirror and Anchor or to build something on top of it. So sort of our recent success in terms of rising TVL and developer attention wasn't designed from the beginning. It just happened as kind of an accident as we were trying to build first use cases around UST. But the way that we look at it is, most people look at Terra and they're kind of confused by what we're trying to do because, we had built and successfully spun out a payments company. It is a layer one. Uh, we have stablecoins that sprawl across multiple different ecosystems. I think it's like 4 or 5 blockchains at this point. So it's kind of hard to pinpoint what exactly Terra is trying to do. But at TFL, we're pretty there's no confusion about what we want to do here. So our main goal and the only product that we look at is the Terra stablecoin, and our goal is to make that stablecoin the most decentralized and useful form of money there is. And for everything else, it's just a means to an end, right? So if Terra succeeds as a layer one smart contract platform, then great. Why not? But from our perspective, we place no difference between UST being used on the Terra blockchain versus Ethereum or Solana or Avalanche. We're pretty agnostic to that. Insofar as lots of users are gaining benefit by using the Terra stablecoins, we're indifferent to the context in which these stablecoins are used.
That's very cool. Yeah, so Terra's product is UST, and the smart contracting features of the layer one are just a way to bootstrap the utility of UST and make it more useful. But actually, it's possible that at some point, if another layer one ecosystem ends up being the winner, whether it's Solana or Ethereum, whatever, UST could still be the sort of settlement currency of that ecosystem as long as it wins as a decentralized stable, even if sort of Terra as a layer one doesn't win.
Correct.
Yeah, that's interesting. Yeah, that's super interesting. And then we've spent a bit of time on Terra's finance ecosystem. I'd like to spend some time on the spending because for me, it's they're kind of like two parallel tracks, right? One of them is making sort of Terra more useful as investment and savings, and UST more useful for investment, for savings, for financial primitives with all the stuff that's happening there. And then the other one is making it more useful in the real world in terms of actual payments. And there's a lot happening there as well. Could and I guess at some point the plan would be to link them so that you have like this stablecoin that's hyper useful as part of the centralized financial system, and then you can also like spend it everywhere. Maybe could you give some update on what's happening on the spending side with Chai, with Cat, with Cash, Alice, all of those?
Sure. Um, so the motivation for wanting to start payment companies was pretty simple. So I wanted to get to a state where I could simply do all my finances in the Terra blockchain and then never have to actually touch a bank account. And for me, unless I have to get some paperwork signed or something like that, I don't go to the bank. So, for example, I take out my staking rewards and then convert that to KRT, pop that up into Chai, and then make purchases for whatever I need, across restaurants, general purpose e-commerce, food delivery, all from the Chai app or by using the Chai card. So we wanted to sort of close the retail loop on what people can do with their money. Um, so the in terms of the things that we've been doing with payments is about 2 years ago, we created a payments app called Chai, which was powered by the Terra blockchain. And then we started sort of building integrations with the top e-commerce merchants in South Korea. So today, Chai operates across about 50 of the largest e-commerce merchants in the country, as well as a few offline chains, such as like the largest convenience store or the largest movie theater, bookstore, and so on and so forth. And then in terms of online e-commerce, it sort of fills out the entire gamut in terms of what the most popular internet shopping businesses in the country. So you can use it to shop, let's say baby diapers on Tmon, or order food from Yogio, or you can use it to, buy online groceries from Market Curry. So it's pretty much full gamut as a Korean citizen, what you can do with KRT to buy lots of things. Recently, we've started to work with or observe the creation of different types of neobanks and wallets in different jurisdictions. So, for example, there's Alice coming out of the U.S., which is a neobank where users can deposit UST to earn anchor yield, and then hook up that yield with a debit card that they can spend anywhere across the world. And there's similar efforts such as Capapult in the Scandinavian regions. There's Tick in Australia, as well as tons of different wallets, payment providers, and neobanks that are popping up across the world.
Damn, that's awesome. I didn't even know about those. And all of these will enable you to spend UST in their various jurisdictions. So they're getting the appropriate licenses and payment processing licenses in order to be able to do that.
Right.
And those are popping up independently, or are you like funding or encouraging those in some way?
So to the best of my knowledge, there's like, more than 10 different, payments plays built on Terra that's going on. Because that was sort of like a part of core to our DNA when we first got started. I did fund the Alice because the founder Ichel was a intern at TFL for a while, and then he
Oh,
left
nice.
TFL to start this business. But a relatively small stakeholder.
Okay, very cool. And when do you see like the bridges happening between these payment apps and sort of the TeFi, Terra's DeFi ecosystem? Like, when do you see, for instance, Chai, like an anchor or mirror integration into Chai or into some of these payments apps where people can pay through them, but they can also like save, they can also have access to investments and all of that. Do you see that coming anytime soon?
Yeah, so for Chai, Terra Station is already integrated. So if you deep link Terra Station once, then in that case, and then you sign a special transaction that allows Chai to withdraw up to X amount in Terra stablecoins, then in that case, you can shop on Chai without having to top up manually from Terra Station. So I guess like a low hanging fruit that we can do is to integrate Anchor into Station. I think we're actually working on that now, in which case like you could be earning anchor yield while at the same time shopping in Chai. In terms of a native deposit experience in the Chai wallet itself, there's a sort of a new license that's coming out in September 25th in Korea, in which case you, you know uh, payment providers would be able to offer some crypto facility as insofar as they meet the proper requirements, which Chai already does. So I think starting at Q4 of this year, we will start to meet some of the qualifications for sort of a native deposit experience, and I think we'll be able to do lots of interesting things. Um,
That's super cool.
in terms of Alice, they have an alpha out, so I think they're gearing up to a public launch in November. So that should be
Okay.
exciting. And there's a few other neobanks that are in extreme stealth, but I think those should be rolling out relatively soon as well.
That's super exciting. Yeah, I mean the yeah, that's super exciting. Um, so earlier this to kind of pivot over to some of the risks and like especially the regulatory side. Earlier this year, you tweeted that crypto is at war. Like, what did you mean by this? And I guess how do we win this war?
Yeah, so not surprising to myself or other founders in DeFi, but recently there's been a lot of chatter about, you know, um, stable coins and crypto having to be more regulated, especially from the United States. So, for example, Janet Yellen made some comments about how stable coins have to be regulated by the U.S. Treasury, and then the creation of new stable coins has to be licensed by the approval of the Secretary of the Treasury. Now, the interesting thing is the comments didn't pertain to only US pegged stablecoins, but any fiat pegged stablecoin. So, which was interesting that the US Treasury was trying to claim jurisdiction over stablecoins that have nothing to do with the sovereign currency. But I think one of the things that's going to happen as a result of this within, let's say, the next 24 months is that I think there's going to be a lot of uh, regulatory attention on centralized stablecoins, where the underlying bank deposits are under direct purview of regulations in each nation state. So I think what that means is that all the DeFi applications that are built on top of centralized stablecoins are now a censorship risk because it's trivial to, let's say, censor Aave or Compound or some other protocol if the regulator can control the base layer money that is locked up in most of these protocols. So they don't even have to touch the decentralized protocol that sits on top of it. If they censor the base layer money, then they can bring the entire thing crashing down. So I think this is why it's really important for crypto to decentralize or die. So every protocol should have radical decentralization in their mind or be prepared to fail. And I think a huge component of that is making sure that the DeFi stack is built as much as possible on decentralized stablecoins like UST. That's how we win.
100%. Yeah, 100% agree. I think it's sort of inevitable that, and I think the low hanging fruit will definitely be the centralized stablecoins, where there's a bank account, there's an entity, the entity actually has the ability to freeze accounts, right? So it's very easy for a state to coerce them, whether it's by freezing their bank account or by just telling them freeze this wallet. And kind of all of DeFi is at risk, right? Like most of DeFi primitives, whether it's Curve, Aave, are heavily reliant on centralized stablecoins, which, if they were frozen, would lead to sort of insolvency. So yeah, I agree with that. But interestingly, the language that was used, as you mentioned, was pretty broad to the extent that it could apply to something like UST, right, or anything that's pegged to the dollar. Sort of Gensler asserted sort of his mandate over. So how do you think about those risks for Terra? Like to what extent is Terra vulnerable to a regulatory attack, and what are you doing to decentralize or die?
Yeah, so an interesting component of how Terra works is that there's no centralized minter, right? So anybody can mint Terra stablecoins by burning an equivalent value of Luna. So in order for regulators to claim, that people that are minting Terra are broker dealers, or they need some sort of license capacity in an open protocol like Terra, is that they would need to bring like action against, let's say, Hongxia in China, or like Ken, who's like scratching his butt in his mom's basement while he's minting Terra stablecoins in Ohio or something like that. So if you have a large community of people that are just taking, uh, you know, the right and interfacing with an open protocol, then it's just not possible to regulate, right? Like TFL plays no part in people minting stablecoins and then transacting with it in whatever sense. We don't even operate any, nodes or validators on top of the protocol. So I think from that, we have a massive advantage over centralized stablecoins. In terms of how the steps that we were taking to decentralize, I think this is going to be a gradual process. But one of the things that I stress to people that work at TFL is that TFL is a transient aberration, right? So its sole purpose is to make sure that the Terra ecosystem can get to a state where it gets to be a self-sustaining economy, in the sense that even without TFL's help, there's always a new influx of people that are building use cases and apps on top of Terra stablecoins. The Terra economy is in a constant increase, and like the stability mechanism has been stress tested to such a level where it doesn't need people that are solving coordination problems around, let's say network upgrades or R&D about how to improve the mechanism. In which case, TFL will finally dissolve. We will, either find ways of seeding our assets to the community or to burn our remaining assets, and we will just disappear.
Interesting. And yeah, one of the questions we actually got from one of our subscribers as well was what's Terraform Labs' plan for kind of the treasury that it holds right now in sort of Luna and UST, and is there any plan to sort of diversify away from those assets in an effort to sort of I guess be a buyer of last resort for the peg, and like yeah, what's your general thoughts on sort of treasury use long term?
Yeah, so these days I'm starting to notice that like $150 million rounds are small. So one of the things that I was thinking about is to do raises with the stability reserve that we are custodying, and then use the proceeds from that to fund, let's say, stability pools against let's say other stable assets, such that like even if then people have more optionality in terms of redeeming out of their Terra stablecoins into other assets. They can either redeem out into Luna, which is the base layer stability mechanism, but they can also have sort of a stablecoin forex market whereby with deep liquidity, whereby they can sort of transition out of Terra stablecoins into, let's say, well, knock on wood, USDT or USDC.
That'd be pretty cool. Um, okay, that's super interesting. What's the timeline, or how much is this just an idea, or like are you looking at doing this soon?
It's sort of in the idea phase right now, but
Okay.
you know, find me a lead investor and we'll make it happen.
I think we know one, yeah. And then the other thing is that people asked is a lot of sort of Terra's success right now, but I think this applies to sort of most layer one ecosystems other than ETH, is sustained by incentives, right? Whether it's like the yields are kind of sustained by mirror incentives, or Anchor's borrowing is being subsidized by ANC tokens. What do you say to people that kind of worry about the sustainability of that long term, and what are the plans to sort of have real demand come in to substitute that source of yield?
Sure. So I think a different response is warranted for each of Anchor and Mirror and Pylon, because I think each protocol operates a little bit differently. But just to talk about Anchor and Mirror, so for Anchor, I think the ANC incentives was just sort of a temporary incentive until Anchor can operate across multiple different, POS staking derivatives. So in the beginning, when we first started, we just had Luna as the accepted, collateral type within Anchor, and now we have things like bonded Ethereum, and we're adding bonded Sol as well. And then eventually, we'll add a bunch of different POS staking derivatives, such as bonded Atom, bonded Polkadot, and so on and so forth. So I think the ANC incentives, creates token holders from multiple different ecosystems to interact with Anchor. So I think that's a huge plus. But I don't think ANC incentives would need to consist in perpetuity for the protocol to work. So steady state, the way that I'm thinking about it is that the borrower is able to take out a loan in Anchor without having to pay explicit borrowing costs. And then just the yield that is accruing to his staking derivative collateral gets converted to the lender in the form of a stable-ish interest rate. So in some sense, like Anchor becomes sort of a staking yield stabilization protocol. And I think after that, like ANC incentives wouldn't need to continue. For Mirror, I think the MIR emissions play a heavier role than do ANC emissions in Anchor. But I think eventually the state that Mirror needs to get to is that mirrored assets need to operate over concentrated liquidity. So right now, mirrored assets are on Uniswap V2 and TerraSwap. So liquidity is being provided for all possible changes in asset values, but that's a waste of money because, for example, like the price of Apple stock is not going to drop to zero overnight. It's just not going to happen. So in that case, the concentrated liquidity model makes a lot of sense because you just need to make sure that liquidity is available in a very tight band around the current spot price, maybe 10% up, 10% down, or maybe a little bit above that for more volatile assets. And then that should increase the yield that goes to liquidity providers. So I think once we have that concentrated liquidity model and there's more apps that leverage mirrored assets, there's sufficient returns for liquidity providers, even if there aren't incentives.
Yeah, it makes a lot of sense. And how do you think about? And I know we're working on this right now, but how do you think about the concentrated liquidity, the trade-off between sort of capital efficiency, but then also like the composability, I guess, because you lose the ability for LPs to just kind of passively stake their LP tokens and earn a yield, and you'd need to have either strategies, right, some kind of active strategies that they're honored as like the canonical like kind of LP token that are made into CW20s, or you need to have like these professional LPs come in that are kind of doing that work for users. So yeah, how do you think about that?
Yeah, so as you know, Astroport is building in concentrated liquidity for the early
Alpha
version of the
leaked?
protocol. Was that not leaked yet? I'm sorry,
No, no, no.
you can
That's
set
fine.
that
That's
up.
fine. No, it's totally fine.
Okay, so concentrated liquidity rumored to be coming to Astroport, and some of the things that we're building on top of that is sort of an auto rebalancing layer. So the idea is that users can simply deposit their tokens into this pool, similar to how they would provide liquidity to places like TerraSwap, and then depending on how prices are moving periodically, rebalancing occurs to form liquidity around the current spot, such that liquidity providers aren't missing out on that sweet composability they've come to expect and love from
Very cool.
AMMs.
Very cool. All right. Well, this was awesome. I want to ask you maybe one last question. If I came to you from the future and told you that Luna had failed, what would you say the most? What would you think the most likely reason is? Like, what's the stuff that's keeping you up at night? That you're most worried about, if anything. You don't strike me as much of a worrier, to be honest. But like, yeah, what are the things that most worry
Well, I sleep like a baby, so
you?
there isn't too much of that. I don't know, like a million lunatics get hit on the same day with the bus. Um, I, I guess there's that. So look, I mean, so there's a couple of failure points that I spend a lot of time thinking about. So right now, a lot of TVL in Terra is concentrated across a couple of protocols, and a smart contract failure or some economic failure, one of them could have pretty severe consequences for the underlying stablecoin economy. So something that I would really like to do is to get to a state where no one protocol is holding too much assets in UST. So diversification is definitely important. It's kind of like similar to how if Samsung failed, the Korean economy would collapse, and that's
Yeah.
what would happen to the Terra economy if Anchor collapsed, right? So I just found out today that Samsung pays like 1/3 of all taxes in the country. It's like 30% of the GDP.
Wow,
It's
that's
yeah, it's
crazy.
crazy. Yeah. Um, yeah, so diversification is important. I think we need to keep up developer mindshare so that there's lots of chains that want to integrate with UST, lots of DeFi apps, and of course, lots of developers that want to build using UST. So,
Yeah, that's awesome. Do you have any last things you want to mention, or anything that's coming soon to Terra that people should be looking out for? Otherwise, we can call it. This was super cool.
yeah, so I mean, folks, if you're building a sort of a crypto application, don't worry about getting rug pulled by some DeFi developer. If you keep using centralized stablecoins, they're eventually going to rug you. So might as well start using UST now.
100%, 100%. Back that sentiment. Well, thanks very much for being here, Doe. I think our subscribers are going to really like this, and it was a great kickoff to the Terra series.
Yeah, for sure. Thanks for having me.